Good day friends, CEV welcome you for watching this video. Please do not forget to like, comment and subscribe our registered Value Club's YouTube channel for getting all new professional updates. In this video, we will discuss about the valuation precedents in insolvency and bankruptcy laws of India. So, what is that valuation precedents in insolvency and bankruptcy laws of India? In India, the insolvency and bankruptcy landscape has undergone significant transformation with the introduction of insolvency and bankruptcy code. The comprehensive legislation has revolutionized how financial distress is addressed in the Indian corporate ecosystem. We will explore the evolution of insolvency resolution mechanism within India's legal framework, examining key valuation methodologies and landmark judicial precedents that have shaped current practices. Through this examination, we will gain critical insights into how valuation processes influence outcomes for creditors, debtors, and broader economy. So now, first of all, we will discuss about the historical context of insolvency laws in India. The Companies Act 2013, it contained provisions for winding up companies in financial distress but lacked a consolidated framework for efficient resolutions. Before that, another law was there that was for Sikh Industrial Sikh Industrial Companies Act 1985 specifically targeted industrial companies facing financial distress but has limited scope and effectiveness. And then there was another law before the invent of companies law, that was Securitization and Reconstruction of Financial Assets Act 2002, which is generally called SARFASI Act. It focused on enabling banks and financial institutions to recover secured debts but do not address comprehensive insolvency resolutions. So prior to the IBC's introduction, India's insolvency landscape was characterized by a fragmented legislative framework that often resulted in prolonged proceedings and suboptimal recovery for the creditors. This disjointed approach created significant challenges for all stakeholders involved in the resolving financial distress. So, to overcome all these problems, then the Insolvency and Bankruptcy Code was developed. It was started in 2014. Ministry of Finance establishes the Bankruptcy Legislative Reforms Committee to create a uniformed insolvency framework, and in November 2015 the committee submitted the comprehensive draft bill after excessive stakeholders consultation, and in mid 2016 it was passed by both houses of the parliament, that is Lok Sabha and Rajya Sabha, with broad political support, and on May 28, 2016 it receives presidential assent and official notification marking its formal enactment. The development of the IBC represented a watershed moment in India's approach to resolving corporate financial distress. By consolidating various laws and establishing a time-bound process, the legislation aimed to fundamentally transform insolvency resolution in the country. What was the or what are the objectives of insolvency and bankruptcy code? First one is comprehensive framework. It creates a uniform and comprehensive insolvency code applicable to both corporate entities and individuals, replacing the fragmented legislative landscapes. New architecture. It establishes a novel resolution architecture centered around the Committee of Creditors, empowering creditors to make key decisions in the insolvency process. And third one is judicial discipline. It introduces strict judicial discipline in insolvency proceeding through time-bound processes, ensuring the swift resolution and maximizing asset value. The IBC represents a paradigm shift in India's approach to financial distress, prioritizing resolution over recovery. This is the most important thing of IBC, that is prioritizing resolution over recovery, and establish clear timelines to prevent value erosion. By balancing the interests of all the stakeholders, the legislation aims to foster a more resilient business environment. Then, valuation methodology in insolvency proceedings. First of all, the IBC code provided first time the concept of registered valuers. Registered valuers, though it enables that all the valuations must be conducted by professionals recognized by Insolvency and Bankruptcy Board of India (IBBI), ensuring standard expertise and methodology. Valuation approaches. So various approaches which can be used are income approach, discount cash flow method, market approach, comparative com companies, replacement cost approach, and asset valuation approach. Then the timing was also fixed. Valuation timing are anchored to the insolvency commencement date. So this is important thing. Valuations are anchored on the insolvency commencement date to provide a consistent baseline for assessment. Required output. What are the required output for the valuation under IBC? Valuer must produce reports disseminating both fair value and liquidation value to inform the decision makers by the Committee of Creditors. The structured valuation methodology under the IBC aims to provide transparent and consistent assessment of corporate assets, creating a reliable foundation to the creditors and credit decision making during the resolution process. Changes in the asset valuation. So, what are the problems which were before the advent of this legislation? First thing is value erosion, significant decrease in asset valuation over time as corporate operations determined during insolvency proceedings. Valuation inconsistencies, variation in methodologies and assumptions leading to markedly different valuations for the same assets, multiple values, requirement for multiple independent values, sometimes resulting in widely divergent valuations requiring reconciliation. And then process delays, extension in corporate insolvency process timeline contributing to further value depletion. So asset value in distressed scenario presents a unique challenges that can be significantly impact recovery outcomes. The inherent complexities of valuing assets of financially troubled entities, coupled with time pressures and information asymmetry, often lead to contentious valuations that may be disputed by the stakeholders. Judicial precedents in valuation. First and foremost thing is value maximization. Supreme Court affirms maximization of corporate debtors' asset value as fundamental objective. And second thing is time sensitivity as per judicial precedents. Judicial recognition that timely resolution is crucial to prevent further asset depletion. And third thing is asset protection. Emphasis on safeguarding assets through swift implementation of resolution plans. So landmark judicial decisions have played a crucial role in shaping valuation practices under IBC. The Supreme Court has consistently emphasized that the spirit of code lies in preserving the going concern value of distressed business rather than piecemeal liquidation of assets. This is most important thing, that preserving the going concern value of distressed business rather than piecemeal liquidation of assets. This is most important thing of judicial precedents in valuation. So these precedents have established that while valuation exercises require professional judgment, they must be conducted with transparency and good faith to serve the broader objective of the insolvency resolution process. So valuation report. So what are the critical components of valuation reports which are to be submitted by the value? First thing is information memorandum. Valuation reports form the foundation for information memorandum provided to the prospective bidders influencing offer values. Then plan comparisons. Report enable objective comparison of competing resolution plans against established valuation benchmarks, and then these can be used for creditors guidance. So valuation provide crucial guidance to financial creditors in evaluating resolution proposals and making informed decisions. And then information gaps. Report must navigate challenges like incomplete financial records, pending litigation, and contingent liability. A comprehensive valuation report serves as the cornerstone of informed decision making in the insolvency resolution process. By providing a structured assessment of distressed entities' worth under different scenarios, these reports enable stakeholders to evaluate options with greater clarity and confidence. Scope of insolvency proceedings. Companies. So in this slide, we will discuss who can be under what is the scope of this insolvency proceedings. Companies. First thing is companies. Both public and private limited companies incorporated under Companies Act. They can be they can go through these processes. And then limited liability entities, LLPs and other entities with a limited liability structure. Then partnership firms also comes under this law. Traditional business partnerships facing financial distress, and even individuals that personal bankruptcy with specific exclusions for financial service provider. Except for personal bankruptcy can also be taken under this law with specific exclusion for financial service providers. So the IB's comprehensive scope represents a significant expansion of India's insolvency framework, bringing diverse business entities under a unified resolution mechanism. By establishing standardized process across the entity types, the legislation promotes consistency and predictability in distress resolution. The broad applicability of ensures that financial distress can be addressed through structured process regardless of debtor's organizational form or size. Then what is the timeline and what is the process of incorporate insolvency resolution process? Process timeline is 180 days and it is extendable to 270 days in exceptional cases. Moratorium effect automatically during this process. All pending litigations and recovery actions are automatically stayed, and asset protections. During this process, there cannot be any transfer or encumbering or disposal of asset. And then management control. Board of directors are suspending during this process. Management control is transferred to the resolution professionals. And promoter status. Promoters lose operational control but may participate in resolution process with exceptions. The CIRP means Corporate Insolvency Resolution Process represents the core mechanism for resolving corporate financial distress under the IBC. Its time-bound nature and structured approach aims to preserve enterprise value while providing a fair process of all stakeholders. The suspension of management rights creates a critical shift in control dynamics. The suspension of management rights creates a critical shift in control dynamics, ensuring that resolution proceeds without conflicts of interest. Then, valuation and resolution plan dynamics. Initial plan submission. Resolution applicants submit plans based on information memorandum and valuation reports, proposing restructuring approaches and creditors payments. Limited revisions. This is most important. Recent amendments restrict the number and scope of plan revisions to prevent prolonged negotiations and value erosion. Committee deliberation. Committee of creditors evaluates plans against established valuation benchmarks with restrictions on arbitrary plans modifications. Final approvals, and then the selected plan requires 66% COC approval and subsequent judicial confirmation for becoming binding on all the stakeholders. The dynamic interplay between valuation reports and resolution plans forms the heart of the insolvency resolution process. By providing objective baselines for asset values, valuation enable creditors to assess whether the resolution plans offer fair recovery and represent the best possible outcome for all the stakeholders. And what is the impact on the business ecosystem of this IBC? Before IBC resolution, the process time was 4+ years. So average time for resolving insolvency before the IBC implementation was 4+ years. But after the IBC resolution, time has gone down into less than 1 year. So current average timeline for completing corporate insolvency process is less than 1 year, and it has increased the recovery rate by 77%. See this. So increase in financial creditor recovery rates compared to previous recovery mechanisms and ease of business ranking jumps. India has jumped by 63 position gained in the World Bank ranking post IBC implementations. So see how much difference this IBC has made to the business ecosystem. So the introduction of IBC has fundamentally transformed the India's business ecosystem by creating predictable resolution pathways for a financial distress. The shift has enhanced lender confidence, improved credit availability, and encouraged entrepreneurial risk taking by providing structured exit mechanisms with various face difficulties. So what is regulatory framework under IBC? First thing is it has established IBBI as regulator. Insolvency and Bankruptcy Board of India functions as the primary regulatory authority overseeing the entire insolvency ecosystem. Then insolvency professionals. Specialized practitioners certified through rigorous qualification process to administer resolution proceedings. Then information utilities. Repositories for financial data collection, verification and dissemination to facilitate transparent resolution process. Then what are the resolution professional type? Three categories based on experience and expertise authorized to handle cases of corresponding complexity. A robust regulatory framework underpins the effective functioning of India's insolvency regime. The IBBA's comprehensive oversight ensures that all participants in the resolution ecosystem maintain professional standards and adheres to the established guidelines, creating consistency and predictability in proceedings. Then valuation approaches. As you already know, there are different types of valuation approaches as per IBC. First approach is market value based on comparable transactions in open market reflecting what willing buyer and would pay for the asset in current condition, most relevant for liquid assets with active trading markets. So it is based upon the recent sale prices of similar assets with adjustment for specific characteristics. Second approach is intrinsic value. So it is calculated based on fundamental analysis of assets, underlying characteristics, and expected future performance. Often uses discount cash flow methodology. So generally discount cash flow methodology, which is DCF adjusted for time value of money and risk factors. And third thing is liquidation value. It is estimated proceeds from the asset disposal in distressed conditions under time constraint. Usually represents a floor value in resolution proceedings. So it is based upon forced sale value of individual assets less liquidation cost and liability. The diverse valuation approaches enjoyed in the insolvency proceedings reflect the multifaceted nature of corporate value assessment. By applying multiple methodologies, valuer can triangulate asset values to arrive at more reliable estimates, particularly in complex or unique situations with limited market comparables. So resolution versus liquidation. So this was the important thing as far as IBC is concerned. The main aim was to go for resolution instead of liquidation. So IBC's main aim is the IBC framework prioritize resolution over liquidation. So this we have already discussed. Recognizing that the preserving business as going concerns typically yields greater value for all stakeholders. However, when viable resolution plans cannot be achieved, the liquidation pathway provides an orderly process for asset monetization and distribution to creditors according to the established priority rules. The moratorium remains in force throughout the plan in both resolution as well as in liquidation process, ensuring asset protection and providing individual creditors actions that might diminish collective recovery. So this graph shows successful resolutions, liquidation with no viable plans, liquidation with no resolution, and withdrawn cases. International best practices. So IBC has drawn many things from international best practices. So it has drawn inspiration from global best practices while adapting them to local economic and legal contexts. Framework incorporates key innovations from established insolvency regimes including the US Chapter 11, UK Internal Administration, and Singapore's restructuring framework, creating a platform for efficient creditors debitors negotiations. This international alignment enhances foreign investors' confidence while providing flexibility for finding efficient market-driven solutions that maximizes value preservation during financial distress. Then what are the economic implications of IBC? First thing is loss allocation. So transparent framework for allocating financial losses according to established priority rules, reducing uncertainty in credit markets. Then in perception shift, addressing misconceptions about corporate defaults as business failures versus financial restructuring opportunities. Third thing is stakeholders protections. So it provides balanced safeguards for diverse interests, including foreign creditors, small business workers, and asset owners. Then it has resulted in banking sector health, better banking sector health, facilitating resolution of non-performing assets, strengthening financial institutional balance sheets. The IB's broader economic implications extended beyond individual insolvency cases to influence India's overall business climate. By establishing clear rules for financial distress resolution, the code has enhanced credit discipline, improved lending confidence, and contributed to more efficient capital allocation throughout the economy. Then, technical integration, information utilities, secure digital repositories for storing authenticated financial information, including debt, default, and security interest data. These utilities enable swift verification of claims during insolvency proceedings, reducing disputes and accelerating resolution timeline. Insolvency database has been established, so centralized system tracking individual insolvency proceedings and outcomes. This database provides valuable data for policy formulation, identifies serial defaulters, and creates transparency in resolution ecosystem. Asset registries. Emerging blockchain-based systems for tracking asset ownerships, encumbrances, and transfers. These technologies promise to reduce fraud, prevent multiple financing against the same assets, and streamline liquidation process. So technical integration represents the frontier of India's insolvency framework development, with digital print platforms enhancing information access, verification, and process efficiency. These innovations reduce information asymmetries and create more transparent ecosystem for all stakeholders. Then what is the future outlook of IPC? First thing is regulatory maturity. So continued Development of IBBI as a robust regulatory body with enhanced oversight capability. Then financing evolution, enhanced debt financing mechanism with greater certainty for lenders, revival focus, stronger emphasis on business revival over liquidation through pre-packaged insolvency resolution. Then the most important thing is cross-border framework. So implementation of comprehensive protocols for addressing cross-border insolvency cases. The future evolution of India's insolvency framework will likely focus on addressing the remaining challenges while enhancing the system's efficiency and effectiveness. Developing robust mechanism for the cross-border insolvency represents a particularly significant frontier as India's economy becomes increasingly integrated with global markets. Further timelines in refinements in valuation methodologies and standards will also be crucial to ensure consistent, reliable asset valuations that support fair and equitable resolution outcomes. So, what are the conclusion of this video is to transform India's insolvency landscape. So it provides IBC provides stakeholder balance, means equitable framework protecting the diverse interests. Then it results in economic efficiency by enhancing capital allocation and credit ability. Then the most important thing for us as a valuation discipline. So consistent methodology for asset assessment. This is most important thing as far as value certainty is concerned. Then legal clarity. So comprehensive framework with judicial precedents. So the insolvency and bankruptcy code has fundamentally transformed the India's approach to financial distress resolution, creating a more efficient, transparent, and predictable system. By establishing clear timelines, empowering creditors, and implementing standardized valuation methodologies, the code has addressed long-standing challenges in the insolvency landscape. As the system continues to mature through judicial precedents and regulatory refinements, it promises to further strengthen India's business ecosystem by balancing revival opportunities with creditors' protection. The evolution represents a critical foundation for sustainable growth and financial stability. So this is all in today's video. Thank you. Have a nice day.